Stocks have been on an absolute tear recently, but the question remains, can this bullish momentum continue into the future? Well, in today's video, you and I are going to read through an article from MarketWatch discussing the possibility that perhaps the stock market is pricing in more Federal Reserve interest rate cuts than the Fed is going to provide, and how this could signal trouble brewing ahead. Or perhaps it won't matter. We'll see over the next couple of minutes. But with that being said, if you like this type of content, economics, investing, finance, politics, covering all of those various topics, consider subscribing to the page. With no further ado, let's dive in. The stock market is expecting more interest rate cuts than the Fed can give. The U.S. central bank doesn't have much room to combat the next U.S. economic crisis. With U.S. inflation moderating, the U.S. Federal Reserve will likely cut the benchmark federal funds rate another quarter point on Thursday. They did end up doing that. Stock investors, understandably, are focused on how much further the Fed can take rates down. Investors are hoping for a repeat of what happened after the Fed cut rates a half point in September and major stock indices soared. But the Fed's 2% inflation target, in fact, is somewhat arbitrary. I would argue it's completely arbitrary, not somewhat, but completely. And the central bank could settle for something a bit higher if this accomplishes price stability. Now, a quick point to note here. The reason why I say it's completely arbitrary is because it doesn't matter what inflation is so long as risk assets and wages, one or the other, preferably both, and if you had to choose one, wages, are outpacing the inflation. For example, let's say inflation was at 10%, like it was in 2022, at the height of the supply chain crisis and all of the money being printed into the economy, the extra demand that was completely artificial. Let's say it's at 10%. If inflation's at 10%, but your wages are increasing 15% year over year, who cares? Because you're netting 5%. You're making 5% more every year. Even if the dollar is worth less, you're making more to compensate for it. So it doesn't matter. On the other hand, if it's 10% inflation and your wages are sticky to down, like people experienced in 2022, 2023, into 2024, and right now into the future, then it's a big issue because prices are not going to be affordable for you soon. You're just not going to make enough money. And this goes into the second point here. Price stability. The Fed wants price stability. That doesn't mean they want prices to stay the same. That doesn't mean they want prices to be the same exact year over year, as in a loaf of bread costs $1 this year, a loaf of bread costs $1 next year. No, they want it to be steady and stable, as in they don't want prices to swing up in a crazy fashion, and they don't want prices to swing down in a crazy fashion. Just like they don't want the stock market to be euphoric up or melting down in the other direction. They want stability. They want a nice, even graph. They want a nice, even uptrend. They don't want a downtrend, but they specifically want a nice, even uptrend. Let's continue. Price stability occurs when anticipated inflation is low enough to not appreciably alter household or business decisions. Consumers don't rush to spend today to avoid higher prices tomorrow, and businesses aren't reluctant to invest because falling prices during periods of slack demand could make loans difficult to service. Well, the second statement holds true, but the first statement doesn't. Granted, the psychology could affect things, and you can argue that economics is essentially one big psychological experiment, but I would say that it doesn't have to be low so long as you know you're making more money, right? If anticipated inflation is high, say you anticipated to be 10%, but you're also anticipating that you're going to make 15% more this year, who cares? You'll still spend the same amount. Dollars and cents. They add up for you. You're making 5% more. So I don't agree with that first statement there. But then again, who am I? An open question still is the neutral rate of interest, also called the natural rate, or what economists call R-star. At the neutral rate, the federal funds rate is low enough to maximize employment and still encourage enough investment to accomplish potential economic growth. It's also high enough to not enable excessive consumer and business spending that would overheat the economy and accelerate inflation. According to policymakers' projections, inflation should ultimately settle at 2% and the federal funds rate at 2.9%. That would put the neutral rate at 0.9. That won't leave much room for the Fed to cut interest rates enough to combat the next U.S. economic crisis. During easing cycles from the 1960s through the COVID-19 pandemic, the Fed's fund rate was lowered by an average of 5.3 percentage points. Yeah, in 2008, or leading up to 2008, it was lowered from 5.25 all the way to 0. Going into the COVID crisis, it was lowered all the way to zero. From 1.5 or 2, just smashed it right down. So we have a precedent for this. In fact, I believe during the dot-com bust, it was lowered by 5.25 percentage points too. Indeed, both the Fed's notions and econometric estimates of the neutral rate, and hence where the federal funds rate should settle when inflation hits target, has been falling for decades. Yes, it has, for 40 years. The neutral rate is determined by several factors: potential economic growth, set interest rates too low and businesses will overinvest and accelerate inflation, and households won't save enough to finance investment and government deficits. Demographics, declining birth rates have reduced indigenous labor force growth in recent years. Wow, this article is boring. Lowering both potential growth and the neutral rate. Americans' longer life expectancies and potential years of productive employment should increase the funds needed for retirement and capacity to lay those up, also lowering the neutral rate. My, oh my, this is just dragging. Oh my word. Look at this. Let's get to some of the juicy stuff because we are just talking about meh. My, oh my. With President Joe Biden, the surge in immigration, no, not that. After the global financial crisis, U.S. households burned by too much speculation became both more risk-averse and needed to deleverage, rebuild their balance sheets after taking big losses. Americans were emerging from this when COVID hit, and nowadays investors are again embracing riskier investments, in particular stocks, and among wealthier investors, private credit funds. The federal deficit is now 7% of GDP, giant, the highest peacetime level other than during the Great Financial Crisis and COVID shutdowns, and even higher than during the Great Depression. This taxes the pool of available savings and raises the neutral rate. Yeah. Yes, it does. Fed Chair Jerome Powell seems inclined to look past estimates of the neutral rate, and as data comes in, to simply try to balance what he has called the risk of tightening monetary policy too much against the risk of tightening too little. This time, Powell may find the federal funds rate the Fed can tolerate to be appreciably higher than 2.9%. Now, here's the question. Does Jerome Powell control anything? I'd say very little. I think he is more a psychological manipulator. It's not devious, just manipulator. If you bend or mold things or you alter behavior, that's manipulation. This is not in a devious fashion. I simply think he's altering psychology. I don't think he has anything to do with where the federal funds rate is going. You can see the bond market is telling you where the federal funds rate is going to go. Look at the swap market. The swap market will tell you where the federal funds rate to go. There are far more, let's say, knowledgeable people on this subject than I who are looking at these numbers, because these numbers indicate where big money investors are putting their capital. Just because the federal funds rate comes down doesn't mean that all of a sudden the economy is going to be saved. Doesn't mean all of a sudden that money is getting loose. No, in fact, whenever money is loose, that's when interest rates are high. You don't want them at zero. You don't want them near zero. Low interest rates mean low growth, because what we need to discuss is what interest rates actually signal. They signal growth in inflation expectations. Growth in inflation expectations, as in 5-year Treasury. What is growth in inflation going to look like over the next 5 years? If that dividend yield, if that rate of interest you're getting on that bond is low, that means the economy is not going to grow very much. That means inflation is going to be very low. That means opportunities in the real economy are going to be nil. They're not going to be created. So you hold the Treasury bond because at least you get paid something. At least you get paid some rate of interest instead of investing in risky stocks during a time of economic contraction, which historically, even though nowadays it doesn't seem to matter, have performed poorly during those times. Essentially, what this comes down to in my eyes is that the stock market is certainly expecting a lot of interest rate cuts. And they're expecting a lot of interest rate cuts because historically that's what's happened. Over the past 3 cycles, rates have come crashing down. They haven't been cut slowly. They've been cut quickly. However, this could come to bite them in the butt because every time in the past 3 cycles, and really ever since 1950 when rates have been cut, stocks have not performed well on the back end of that. They have in anticipation of what lower rates will do, but specifically since the 80s and 90s, stocks have not performed well after enough cuts have occurred. Because the Federal Reserve is not cutting rates because they want to manage the economy. They're cutting rates because things are not good. They're cutting rates because they over-tightened. And the Federal Reserve always over-tightens because they forget about one key variable in human life, in the world at large. It's inertia. Inertia is the thing they forget about. Because if you cut and you wait, assuming the cuts are doing anything, then you have to remember that inertia is going to push that forward. It's a train. You can't stop the train immediately. As in, you can't just cut rates and expect the train to, let's pick it up now. No, the train is slowing. The train's not going to pick up speed immediately. It's going to take a lot of time for the train to go from slowing to then accelerating again, and then even accelerating to a point where you're going to see growth. I think that's the biggest thing to remember here, is that most of economics that I can tell, and I did not go to school for this, I'm just somebody investing my own money, somebody that's learning, somebody that's been learning for years. From what I can tell, economics is a psychological phenomenon. What I can tell is that it's no different than the laws of the universe and the laws of nature, the laws of human psychology. In fact, the biggest piece of insight I can give you is that if you can just study those things, all of the economic stuff will just make more sense. You'll see it through a different light. You won't see it through ones and zeros, but you'll see it through people. And people are ultimately what drives this economy. So with that in mind, I don't know what's coming for the stock market coming in the future. Personally, I believe you're going to see a huge run-up. I think you could see $7,000 on the S&P within the next 2, 3, 4 months. But by the time March comes, that could all reverse, and it could reverse in a big way. You could see a giant meltdown. You could see a huge correction from there, 20, 30, 35%, just shaving right off of that 7,000. You'd see a ton of liquidations. And if that happens, you could hit 50 or 60, because it wouldn't be the first time that the stock market has crashed by half or more than half. Great Depression was 90%. So what happens? I don't know. All I know is that the upside is too great to ignore. So I wouldn't be fully out of the markets. That's me. I'm not fully out of the markets. I have cash, but I'm not fully out of the markets because the upside is too great. On the other hand, there is so much risk in the system right now that to be all in on the markets, I believe, and this is the action that I'm taking, so I have skin in this game, I believe it is too much risk to be all in right now, especially if you have leverage. So with that in mind, let me know what you think about this in the comments. Subscribe if you enjoyed this video, and I will see you in the next one. Much love. Peace. This is Nathaniel Kanakal. Have a blessed day.